Good morning and welcome to Market Monday from the investment team in the trust department at the First National Bank. We've got a lot to talk about today. First off, we're going to cover the important data points coming over the next couple of weeks, and then we'll follow that with some analysis of the really interesting market and economic action that happened over the past couple of weeks. So, starting things off today, we're going to get information about consumer credit, which is important because as consumer credit is expanding, consumers are buying more. That means that it's likely that the economy is expanding. And the converse is also true. As that's contracting or slowing down, we would look to that to indicate that the economy is potentially starting to slow down or maybe even turn in reverse. Later on in the week, we'll get information about the mortgage market, inventories and sales, and most importantly, the consumer price index. That's expected to show a climb of 0.6% on a month-over-month basis versus the prior reading, which was only a 0.4% rise. That is not indicative of us having arrived at peak inflation, which is what the policymakers in Washington and at the Fed have been harping on over the past few weeks, that we've already seen peak inflation or we're already seeing peak inflation. The data is just telling us the complete opposite of that. The month-over-month number is what's going to be looked at more closely in the context of looking for a turn, because that's going to be quicker to turn. And while the year-over-year number does show a slight slowing from 8.2% at its last reading to 7.9%, that's less conclusive. That has seasonal impacts that are within that year, whereas the month-over-month number is more in real time what's happening right now with inflation. So we're going to be paying keen attention to that. Does it come in stronger than expected or lighter than expected? Either of those could move the markets. We'll get labor market information and sentiment information, followed by producer prices, and this is expected to rise by 0.5% versus the last reading of 0.4%. Again, these numbers are showing increasing price pressures, not declining price pressures. Manufacturing information about sales, which is really important because ultimately retail sales is the consumer spending represents about 2/3 to 3/4 of our economic growth. That's expected to come in at a growth of 1.1% versus a flat zero as of the last. Now, this one, while it's an important number, doesn't have a lot of economists that were surveyed for it, so this number's a bit up in the air, but it does give us a clue as to what's happening with consumer spending, and that's important. Production numbers and capacity, which ultimately leads into productivity. These numbers are important because they give us insights as to what's happening in the business world. We'll get information on the labor market. And finally, the most important thing next week is going to be the leading economic indicator index, which is expected to come in at negative 0.3% versus a negative 0.4%. And again, this is a small number of economists surveyed. 4 have answered the survey. But if that leading index comes in negative, what it suggests is we can look forward to declining GDP. And if that number is positive, we can look forward to growing GDP. So we're paying attention here in the context of a debate whether we're in recession or not, or whether we've seen a recession or not, or whether we will see a recession or not. Let's jump into the other main driver of markets recently, and that is the earnings season. So most of the S&P 500 has reported already, and really, pretty shockingly, the sales have surprised to the upside almost across the board, with only tiny failures to surprise upside or meet expectations, and that in communications and industrials. This is a very healthy result, a very good result, but we don't know that that's going to last because we do see signs that the consumer is slowing down the rate of purchases. These numbers are likely to trim going forward. Earnings is the same thing. We don't think this is representative of the inflationary pressures on margins that have yet to make their way onto these reports. That said, earnings have been worse than sales, and we do have materials, industrials, and communications, all with meaningful undershoots of expectations in terms of bottom line earnings. That's reflective of two things. Number one, we've had producer prices rising at north of 10% and consumer prices rising at around 8%. That means that companies have their input costs rising faster than what they can raise their prices by, definitionally, that is smaller corporate margins or dollars per unit sold. So, in that context, smaller margins is one of the key drivers of lower earnings. Another driver is lower sales, and we're seeing signs that the consumer, while still spending and still somewhat growing spending, is starting to slow that pace of spending down. And if and when that happens, these sales numbers are likely to come in lower, and the earnings numbers are certainly going to start coming in lower. So we're going to see a different result probably in the Q4 earnings season. However, let's look at the expectations. So for the year, this 9.45% represents consensus earnings growth estimates in the S&P 500. We don't think this is realistic at all in the context of the inflationary measures that we were just discussing. We think that analysts have not adjusted their expectations accordingly, and this is not going to be anywhere near the 9.45. So what are the implications for markets? Well, here's where it really gets positive. One of the best indicators of a market bottoming process is when you get bad news and the market is remaining strong at some level. And last week's Fed meeting was a classic indication or a classic situation like this. The 75 basis point rate hike was widely expected, and the market rallied on that news. Then, during the press conference, the chairman came in with a very unexpectedly hawkish tone. And when we say hawkish, we mean very, very aggressive against inflation, to the point that it was even stated, they're willing to accept job losses. They're willing to accept declines in GDP or a recession in order to get inflation under control, that's their prime objective at the moment. And predictably, the market went down from this 3,900-ish level all the way down to 3,700 in the S&P 500, which was actually, a little bit into the next day. But it was strong after that and holding. This is following on earlier behavior in the year. And earlier in the year, in June, we had the first attempt at a bottom. The market trickled up from there. It found strength down here. Came back down again recently in the late September and through October. Here's where we got CPI data the last time, and the market opened sharply down and quickly reversed higher and was holding that level, and we're just hanging on, kind of trading around this range. This is supportive of our thesis that we're seeing the market bottoming, even though the news is expected to come out worse over time with respect to earnings and potentially for the foreseeable future with inflation. The market has strong buying interest down in this area, and so long as that has happened twice, 3 times, 4 times, the stronger the case gets that the market is bottoming. And it does tend to bottom well in advance of an official call of a quote-unquote recession. And we're looking for that to occur sometime in 2023. So it makes sense that the market may have begun its bottoming process. Certainly seeing it react on bad news and find a stability point is positive for our outlook. And then, just to kind of put things into their longer-term context as we wrap things up with this video, we're not looking at what happens over the year. And it's been a frightening year. It's been an unnerving year. It's been a volatile year. We're looking over the long term. And over a 20-year period or a 10-year period, these things work themselves out. That's why we advise clients to stick to their long-term plans and not make long-term plan decisions based on short-term market activity. With that, the last item we're going to look at is interest rates in bonds and in corporate bonds, because investors for income are in a really good place right now. 2-year paper is over 5%. Even 1-year paper is over 5%. And at 5 years, you're getting 5.3. At the beginning of the year, 1-year paper was about 57 basis points, or about 0.5%. And 5-year paper was only 1.66%. So income investors are seeing benefits from the current environment, and your bonds tend to hedge some of the equity volatility. If you have questions, if you have concerns, we want to talk to you about it. Please know we're here for you. Reach out to us, and we hope that you found this video helpful. Thank you, and have a great day.